anywhere between, these are families anywhere between 300 million to 200, basically between, I'm sorry, 250 million to $30 billion. And what we do is I act as a kind of the quarterback, and we invest in the private markets. That's private equity, venture capital, real estate, and credit. Um, we don't charge anything, but I'm not doing it for selfless purposes. I do it selfishly because I'll put in $2 to $3 million per deal. Without their 50, $100 million, I wouldn't be the first call. So I call it first call alpha. So that basically what I do is do direct deals in the private markets. And then I'm in the process of putting together a family office initiative. I created one at Stanford University. And we put together, I chaired the Disruptive Technology Center at Stanford, and we put together a conference there. And we're in the process of putting together a family office initiative at the University of Chicago. I also sit on about 10 different boards and chair 4 of them. And I've got a podcast on family offices and a newsletter, which I just launched.
Appreciate, Ron. So I was just start our call today just on a recruitment matter. So I will give you just in short example or just a quick view on a discussion what I have had just a couple of weeks ago with a principal of a family office, and he is just at this time looking for a new family officer. And we had a pretty good discussion, and he was explaining to me, or he was asking to me, is it just better to have a family officer with a background coming from a management consultancy and rather than from a bank or from a wealth manager? And I was responding to him and asking, can you tell me a little bit, what's the conclusion of your thoughts? And he was explaining to me in regards of these upcoming evolution of family offices. He was considering it just better to have he called as a co-CEO of the family sitting in a family office, thinking around the corner for the family and for the principal itself, and also be able to initiate strategic initiatives for the family office. And he was explaining also to me that from his experience, many of these, let's say, traditional family offices are mainly unable to make this strategic effort because they have a background in the financial industry. And so therefore, that was a quite interesting discussion. And I will pull these questions to you, Ron. What's actually your view on the role of a family officer? Is this just also in request to on a further development or on a different skill set? What's requested in the future for a family officer? What's your view on this?
Well, it's a great question, complicated answer. It's interesting because there's roughly 15,000 family offices throughout the world. But it's a relatively new phenomenon. 68% were created since 2000, half since the crash of 2008. So this is a new phenomenon. And the issue is really that the model doesn't really work. I mean, only 25% of families make it to the second generation, and 10% make it to the third, and 5% make it to the fourth. So you've got all of this talk about creating and starting these family offices, which is terrific, but the model just doesn't work. And the problem is that the family offices in general are very fragmented, very siloed, and very inefficient. And you've also got $10 trillion in capital in family offices. And to kind of put that in perspective, there's 6.5 trillion globally in the entire hedge fund universe. But even more important than that, over the next 20 years, we are about to experience the largest transfer of wealth in history. There's $84.4 trillion, which is coming downstream from the baby boomers to the next gen. So this family office market, as inefficient, fragmented, siloed as it is, will be larger than the private equity and venture capital and hedge fund markets combined. But we're only in the second or third inning right now. And I think there's a lot of things that have to happen in order for family offices to become more efficient, less fragmented, and less siloed. So there's a lot of work that still needs to be done.
And in regards of these role of these family office executives, from your experience and from and on your perspective, what should be the skill set of an, let's say, of a future family officer? Is it just more on leadership? Is it just more on to be able to strategic initiatives for the family offices with an impact on the family itself? What is it actually?
Sure. I think if you're asking about specifically about the CIO, the chief investment officer, his role.
I would say the chief executive officer, the family officer.
It's a great question. Most families don't have it really defined. And I think part of the problem is that people have a liquidity event, they sell their company for $1 billion, and then they start investing. And a lot of this is not really thought out, in my opinion, too carefully. It's a different skill set. So Ty Warner created Beanie Babies. Brilliant, brilliant businessman. Sold the company for several $billion. And then he tried to buy hotels, which was a disaster. And I'm not picking on him, but it's a different skill set to create what he created, which I couldn't have done, than to invest. So you've got huge amounts of capital in very inefficient hands. And for this, to answer your question for what should the CEO role be, it's not just an institution because they're not looking just to create alpha. This is a family, and the family has a second or third or fourth generation that they're looking to pass this on to. So a lot of this is psychology. A lot of this is almost becoming a psychologist, working with a different family members. And in order for it to work effectively, the CEO has to be able to communicate. That's the most important thing with all the different family members. And the patriarch or matriarch has a certain initiative, and they need to be able to certainly relate and talk with them. But you've also got kids. I mean, kids could be 60 years old, but you've got kids and grandkids and next gens and brothers and spouses and in-laws, and all of these things have to happen. And it's not, it's very fluid. So in order to navigate that, the role for a CEO is not just something you can quantify. A lot of it's going to require something I call EQ, which is emotional intelligence.
Is it just more when I say and I in my mind's pop up these interesting article last year from Tom McCullough, the CEO of the Northwood Family Office, and he have described these integrated advisor role or the rising demand of an integrated advisor. Can this be or could be this the role for let's say an upcoming chief executive officer for the family office, acting also as an integrated advisor in both sides for the family and for the family office itself?
Difficult question. I just think that we're at a point right now where we're so new in this. I mean, people, in Europe, family office has been going. I mean, you'd argue the Medicis were the first family office, but in Europe they've been going on for centuries. In the U.S., really, it started in late 1800s with Rockefeller and Vanderbilt. But if 70% of family offices started since 2000, it is a very new phenomenon. So I think that family offices are getting to the point where they need to really collaborate with other family offices and share best practices, and they really don't. And what happens is when somebody has a liquidity event, the first thing they want to do is invest in a great private equity or venture capital or direct deal. The first thing they should do is talk to an estate planning attorney. That's the kind of the foundation of a house, but they don't do that. So there's no real playbook for family offices. So right now, I would argue that probably close to 80% of the family offices that exist should not exist as they currently do. They need to get more professionalized. So you look at one end of the spectrum, I'm very close with Paul Carbone, who runs the family office for Tony and JB Pritzker. They've institutionalized this. They've got a team of 65 people who will vet deals, and they can compete directly with Carlyle, Blackstone, KKR. And in many instances, they've got a better model because they've got patient capital, which is something we'll touch on in a minute. The vast majority of the family offices can't compete right now because they don't have the infrastructure. That will change, but it's going to take 3 to 5 years to do it. And part of what we're looking to do at University of Chicago is to create a program where families can really learn and understand that this is a business, just like their business where they had their liquidity event. You have to look at this like a business, and that's what we're trying to create.
What's actually required for a family office to compete with these mentioned private equity funds?
A lot. You need, first of all, most family office, you need the infrastructure, first of all. Secondly, in order to get the infrastructure, you need to compensate these people. So the problem right now is that family offices, if a family office today is going to pay a kid $250,000 out of Stanford or Harvard, many of them look at that as a cost. In other words, that cost me $250,000. If Blackstone or KKR hires a kid out of Stanford or Harvard for 250,000, they look at that kid as a potential $20 million profit center. So it's nuance. It's not a cost. It's a perspective. And until families start looking at it from that perspective, that it's not a cost, and they have to look at it like they grew their business, nothing's going to really change. There's only a very small handful right now of people who've done it effectively, like the Pritzkers. Michael Dahl's done a great job. Sergey Brin's done a great job. Bloomberg's done a great job. And there's a handful in Europe that have done a terrific job. But the biggest advantage that family offices have is something called patient capital. So the problem is that a lot of these family offices, it's not that all of a sudden people wanted to create family offices and manage their own money. The reason, the impetus to do this was a lack of trust on Wall Street. So when 2008 came on, I used to run a hedge fund, so I could put up gates, which mean you can't sell. Well, if you're a widget manufacturer in Wichita, you don't know what gates are, and it doesn't seem fair that I could do that. So I think that the growth in the family offices had to do much more with lack of trust from Wall Street than I really love managing money. So you've got huge amounts of capital in what I would say today is inefficient hands. And the rationale for starting the family office was not really valid, at least in my opinion. And what happened was post-crash, pre-COVID, with zero interest rates, it didn't matter what you invested in, it went up. Private equity, venture capital, real estate, credit, Bitcoin, the stock market. It wasn't complicated. So a lot of these family offices said, well, I'm going to do direct deals. And they're going to, why should I pay a fee of 220 to a manager if I could do it directly, make money, and not pay a fee? And they were right until they were wrong. And what we saw happening is about 18 months ago, when the Fed started jacking up interest rates, these family offices realized there's a skill set to being in private equity or venture capital or real estate or credit or whatever the asset class is. So I think what happened previously is you had a lot of these families made what they call easy money back then. Now, over the past 18 months, we're going to see a lot of family offices really recalibrate on what they're doing because they're not only not making money, many of them are losing money now. So they're starting to realize that there's a skill set, and paying 220, paying fees and still making money, but paying fees is better than losing money. And I think that's what's going to happen. So I think you're going to see a backlash. It's starting to happen right now. Very few families are competent or capable of doing direct deals. Many of them try to do it, but you can't sell your company for $1 billion and hire your son-in-law, who just graduated with straight A's from Indiana University as a CIO. It just doesn't work. So as long as it's looked at more like a business, that's what has to happen.
In regards to what you've mentioned, and that's also, in my opinion, running as a business. Just as a forecast, on your opinion, will we see an increasing amount on new family office, let's say over the next 2 or 5 years, and also just in increasing movement and consolidation of family offices? What's your opinion on this?
Yes and yes. So look, there's 84.4 trillion that's coming downstream from the baby boomers of the next gen. So by definition, there will be more family office created. There's currently about 15,000. And the other thing you have to think is, what is a family office? I mean, look, you could sell a company for $20 million. I make no judgment on anybody. I mean, if they made their money doing anything, they could do whatever they want. Um, in order for it to make economic sense to have a family office, you need $250 million minimum, US dollars, for it to make economic sense. Otherwise, you're better off going to a multifamily office, which are basically built for individuals between 10 million to 200 million. Yet there's a lot of family offices that are under 250 million and they do it themselves. But if you do the math, if you reverse engineer it, if you look at you have to, with a single family office, you've got to pay your own accountant, your own admin, your own lawyers, and it's very expensive. So you're better off sharing those costs. So a lot of them right now are really, we're still very early in, just because you had a liquidity event and you sold your company for $50 million, which is a lot of money, it's just not enough to have a family office. So I think the number of family offices is going to increase dramatically. I think the second question, consolidation, I do think I did a podcast with David Rubenstein from Carlisle, and what he said, and I believe he's correct, is that in 3 to 5 years, you're going to see some of these family offices that are as well known as KKR or Blackstone, these firms. They're not now, but they will be. And we saw happening when Michael Dell's family office merged with BDT, with Byron Trott. Um, that's what they're trying to create. And I think it's a really interesting model. But I think you're going to see more and more of these family offices realize that you want to have in order to do it efficiently, a smaller number but consolidated of larger family offices. And I think that's what's going to move the needle. And that's what's going to cause the disruption in private equity and venture capital. Because without that, in theory, the patient capital in the family office model is a better model. But in practicality, it doesn't work. Once you get enough people and once you've got the infrastructure, then you can disrupt private equity. You'll never replace it, but you can start disrupting private equity and venture capital because both of those businesses have become an AUM game. And again, in order to create true alpha, you really need to operate. And many of these private equity and venture capital guys, if you look at the firm, they're finance guys. And there's nothing wrong with finance guys. It's just that I could financially engineer almost any company, but to create true alpha, you have to operate it, and that's what family offices do, and that's where they made their money. They were operators. So I think that you're going to see a trend of people realizing this is a full-time business. If this is what you want to do, you have to learn. There's a huge learning curve to doing this, but if you can do that, and if you can connect with the right people, it is a superior model, in my opinion, than the private equity and venture capital because they're compensated to flip companies every 3 to 5 years. That's not bad. That's just the way it is. Well, if you look at what happens, certainly in the United States, probably more so than Europe, if a if a private equity firm buys a business from a family, they'll hold it for 3, 4, 5 years. and then sell the company. But they'll sell it sometimes to private equity firm too. And then they'll try to extract profits out of that, and they'll hold it for 3, 4, 5 years. And sometimes they'll sell it to private equity firm 3. So over the course of a 20-year period, you could have 4 to 5, the company change hands 4 to 5 times. And if you look at the taxes and the friction and the disruption that that causes versus a family office who can buy it, hold it for 20 years, compound everything, not have the friction, not have the taxes, not have the disruption, it's just a much better model. But we're not there yet, but we will be there. So this is changing in real time. And I think over the next 3 to 5 years, more and more firms will look to family offices as their first choice. When I talked to Tony Pritzker, who's brilliant in how he created his family office, he didn't even want to call it family office. He refused to call it a family office. He called it family capital. And the reason he wouldn't call it a family office is because the perception in general is family offices are whimsical and not very efficient, and he's correct. So that's why he insisted on calling it family capital. So again, I think we're 3 to 5 years away, but this is changing in real time, and we're going to see massive changes in the way companies are financed going forward.
That's great. That's great. And there is another question. What I want to ask is just, I mean, in reality, what we see today is just to have a family office just is fancy, right? It just in many cases it's just a status quo to have one.
I'm going to go further. I'm going to say it's ego.
It's ego, right? It's ego, absolutely. And what I want to know is just, do you have just a feeling in regards, because many of these principles, especially in the generation one, if they have their business, they underestimate this transition from an entrepreneur and becoming an exceptional investor. Do you have just in idea what's actually the time frame or the timeline to become an exceptional investor?
They're two totally different skill sets. And what happens is when an entrepreneur built a company, what I've done to build my company, what entrepreneurs do, is they typically surround themselves with people that are smarter than them and let them do. You can't be good at everything. You're good at 1 or 2 or 3 things. So when they built their business, they basically were really good at something. It could have been sales, it could have been marketing, it could have been finance. And then they let the other experts do what they did, right? That's really how they grew it. In investing, it's a completely different skill set. And we saw that Ty Warner was just one example, but I can give you hundreds of examples of people who have sold their company for a lot of money, and they're brilliant in real estate or in venture capital or in private, whatever it is, but you can't be good at everything. And the biggest obstacle to me that many of these family offices have is the ego of the founder. And you know, I always like to be the dumbest and the poorest guy in every room that I go to, right? I'm in many instances that's the case, but I'm fine with that because you want to surround yourself with people. So you've got, because you created a multi-billion-dollar company doesn't mean you can run a diversified portfolio and make it last 5 generations. Two completely different skill sets.
Yeah, I mean, I've heard just from a principal generation with 3, and he told me it took between 5 and 8 years, and the chance is that you make a lot of dumb investments is just on a high risk, and that could be also a great risk for the family wealth itself.
Well, look at the statistics. Look, 25%, the statistics are this: 25% of family offices make it to the 2nd generation, 10 make it to the 3rd, and 5 make it to the 4th. That's all you need to know.
Yeah, great. So I would say, and I would take the invitation to give you guys just the opportunity. Do you have any questions in specific? What do you want to know?
Yeah, I would ask a question like, if current family offices are as inefficient, like what are the main mindset blockers that are stopping them from becoming more efficient? Like, should they hire more consultants? But then like, why would they trust them? Or what do you think? Like, what
Okay,
would
I'm
be
gonna
the
go
best?
back to my first thing, ego, the ego of the founder. I'm gonna go back to another thing that because you sold a company, whatever the company is, it could be you made popcorn. It doesn't matter what you did. Um, it doesn't make you a good investor. It makes you good at running a company, a business. And what happens is the blood, sweat, and tears that go into growing a company and being an entrepreneur, and then ultimately, if you're successful, to having a liquidity event, that's a lot of work. And what happens is a lot of times people like, okay, I've busted my butt for 20, 30 years. I sold my company for $1 billion or whatever the number is. And the mindset is almost now I could take my foot out, I've now got the money. I'm going to take my foot off the gas pedal a little bit, which is fine. But if you do that, you shouldn't run a family office. You should outsource it. If your mindset is, I'm going to run this with the same energy and vision and ambition that I grew my business, then you can create a family office. So, as I said, in my opinion, 80% of these family offices, and it might even be more, should not exist the way they currently are. But people, again, because everything went up for 10 years when interest rates were zero, they were still making money and they could still do it. When interest rates started to rise and people started to lose money in venture capital, in real estate, they're not going to be able to they're way over their skis in real estate. They got into multifamily deals, they're not going to be able to refinance these deals. They're not experts in it. So I think that's one of the things we're trying to create at University of Chicago is an initiative to educate these families. And as long as you could put your ego aside and you want to be a lifelong learner and surround yourself with people that are smarter than you and grow it and learn, you can do it. If you don't, you should not have a family office.
Thank you. It is it do they need to be the subject matter experts at the market they're trying to operate in? If they build a company that is in real estate, like, should they keep their family office investments around the real estate area? Or do you see that should they be more open to changes towards the
No,
market?
no, that's a great question. And here's the answer. If they made their money in real estate, they should focus on real estate and outsource the rest. So they do real estate, but private equity, venture capital, credit, special situations, that should be outsourced to other people. They made their money in tech, great. Focus on technology, outsource everything else. And that's not happening. I think it will happen, and it's starting to happen because people are losing money in deals. I mean, Carter did a study, the average Series B investment was down 50% last year, and Series C was down 75%. So when you're actually losing money, that's the impetus to change for these family offices. Post crash, pre COVID, when everybody's making money, you're not thinking. You think you're smarter than you are. There's a skill set to do this, and you're good at something. You can't be good at everything.
That's great. Andrew?
Thank you.
Yeah, thank you, Jan, and thank you, Ron. That was really good kind of presentation. There's actually taking quite a few notes there. Thank you for that. The question I have was something that you touched on and something that Jan mentioned, and I was thinking of as you spoke, Ron, which is around consolidation, and it might be answered by what you just mentioned there as it relates to education. My question is, what gives you the feeling, or you might have real data or real examples, that there is actually consolidation that will be taking place with single family offices? The reason why I ask the question is because, as you mentioned, ego being the biggest enemy of these people, as well. I also know that as you mentioned, they are siloed, they are secretive. They want to and they are all somewhat. A lot of them are becoming newer and newer as we're getting this huge transfer of wealth. how does that change? And is it through your educational kind of programs? How do you see the consolidation coming down the road?
That's the $64,000 question. But I do think it's going to happen. I think it can't not happen because at the end of the day, I mean, I start with the premise that people are rational, and if they're losing money, they're not going to continue to lose money, right? So they're going to try to reevaluate what they're doing, and I think that you're going to see best practices. So again, understand where I am in the U.S., it's a much newer phenomenon than in Europe, right? This is only if 70% of the family offices started since 2000, it's a very new, and half started since 2008. It's a very, very new phenomenon. So I think what'll have to happen to change is education, networking, sharing best practices. I keynote a lot of these family office conferences, but it's service providers many times pitching to service providers. And the model is it's a pay to play model. So for instance, Andrew, if you're speaking and let's say your expertise is venture capital, you might be really good or you might be really bad, but I know you've spent 25 grand in order to speak. That's not why I should be listening to you. So these family offices come to these conferences, and now family offices typically aren't going to these conferences. They're bypassing them. So when I did it, when I was at Stanford and I chaired the Disruptive Technology Center, I said, let's put together a family office conference that I would go to. Because the 100 families we invest alongside, they say, which conferences should I go to? Because I keynote a lot of them. My answer is almost always none. They're not worth going to, most of them. There are some good ones. At Stanford, what I said is, I had a theory. I said, let's put together a family office conference that I would tell the 100 families I invest alongside they should go to, or I would go to. We had Kirkland and Ellis and EY, because we do a lot of work with both firms. They sponsored it. Okay, I said, I don't want to do any of the work. What I will do is I will get you best in world-class speakers on world-class content without selling anything. It's very simple. So 3 examples, we had Paul Carbone from the Pritzker family office. He was focusing on due diligence. What he talked about was, here's how we do due diligence. He wasn't raising money for a fund. Tim Callahan was Sam Zell's partner. This was during COVID. He was talking about how he felt the market for office space is going to happen in the next 3, 5, 10 years. He wasn't pitching anything. He didn't have anything to sell. And then we had Denise Illich from Little Caesars, who helped to rebuild Detroit, along with Dan Gilbert. She wasn't asking for people to donate to her charity. All she was doing is saying, if you're going to be philanthropic, here's how you might want to think about scaling it, and here's what we did. So it was pure educational. Nobody was selling anything. We had 880 families from 6 continents on a Zoom call during COVID. There's a huge demand for content. That's what we as an industry need to do.
Yeah,
Thank you.
no point on this. So we are coming to the end. Happy to see you, Marcus.
Hello. Hi, guys.
Do you have anything what you want to ask Ron or the audience, especially on the topic of family office? I mean, you're a family office expert in Switzerland and international as well.
I was super happy to hear what Ron was saying about investment management, because this is also something I always tell clients: forget about investment management, doing it by yourself, outsource it, let professionals do the job. Because as you also, Jan, often say, it's quite difficult to transition from entrepreneur to investor. Very often you don't have the expertise. The only exception there I see, and also Ron already mentioned it, was if you have domain expertise in a specific industry, yes, then it makes sense. But otherwise, let external providers do the job. And the nice part is, if they don't deliver, you can change them. You can replace them immediately. If you have a team in-house that doesn't deliver, that is going to be very costly, and it's not only costly in terms of financial terms, but it will also cost you a lot of work, effort, and time.
That's great.
That's a very good point.
Very, very good. So
Thank
I appreciate your time. Doesn't really matter. We was a small round, but I hope it was also very efficient for you guys. And I would say let's bring the leading heads together. And in regards what Ron was mentioned, organize small circles or family office rounds with pure educational content, because that should be the direction to support these families, family office staff as well, and that they become more professionalized and say more institutionalized. And because in the end of the day, family offices and the family office and the families behind are very important for us as the societies, right? So, and for therefore, let's make it happen and avoid all these paper conferences around the world. So, it was my pleasure.
Thank you very much for having. Thank you very much for having me. Very much appreciate it. And again, you do really good work. I think you add a lot of value to the family office community, and I thank you for your contributions to what
Cheers.
you do to the family office ecosystem.
Have a nice day. Bye-bye.
Thank you.
Thank you, everyone.
Bye.
Goodbye.
Thank you.